We've got two lenders here from Streamline Loans. We know we've had a lot of questions regarding lending and what's going on in the market. So we've got Joseph.ciaglia and Jonathan Jacobs here from Streamline Loans. Jonathan, how's it going?
Great, Brendan. How you doing?
Pretty good. How's it going, Joey?
Doing great. Thanks for having me.
Joseph, should I get formal on you today, Joey?
Joey, I like it. We'll go easy.
Yeah, so we've had a lot of questions from people just regarding, hey, is now a good time to refi? How's the market? All sorts of different things. So I figured why not get to the best in town to kind of fill everybody in and let them know what's going on and get some good information. So one of the questions, we'll jump right to it, was what's the state of the current mortgage industry as a whole?
I'll take that one. Definitely a great question. The mortgage industry is alive and well. We're still originating loans. Our investors are still funding loans. Our processing is quick as it's ever been. There's definitely been some changes that we've seen come about in the last 30 days, which I'm sure we can get into with some of the questions. But as far as the mortgage industry goes as a whole, we are still having purchase loans go through. We're still having refinance loans go through, and there hasn't been any major change. We still have historically low interest rates. Obviously, we can talk about that as well with the changes that the Fed has had in the last couple of weeks. But as far as an overall picture goes, we've had changes. We've adapted to those changes. Our investors have adapted to those changes to make certain guidelines shift so that it's easier for our clients to get financed, but we are alive and well.
That's good to hear. What is the current balance? I know typically for you guys, usually you do more purchase contracts. Is there a different balance currently between refis and purchase contracts?
I'd say for the industry as a whole, refis are definitely up, right? And purchases are down right now. For our shop in particular, we are normally about 90% purchase and about 10% refi. Right now, it's probably more 50-50 for us. There's definitely a lot of people taking advantage of the refi market, the fact that the rates are low. So it's evened out a little more than usual, but the purchase business is still there and it's strong.
And what would you say currently, like where are rates currently for refis and purchases? Where do you find the rates currently landing? Obviously, we're not going to hold you to it, but because they change pretty much daily right now, right?
Yeah, well, they change daily all the time, but as of lately, they've been changing more rapidly, and there's been bigger swings. Right. So right now, today, the average 30-year on a conventional loan is about 3.75. VA is probably around 3.5, and FHA is probably around 3.25. Now, those are averages on par rates. Okay, meaning that obviously credit scores, debt to income ratios, other factors impact those rates, and depending on the type of property, for example, if it's a primary residence or investment, or if it's a condo or single family. A lot of different factors will determine the rate, and will do what's called adjustments, right? So the 3.25 is the average rate on a par rate without adjustments. So if you have a 800 credit score, obviously you're going to get a much better rate than if you have a 600 credit score.
So a lot of those things still pretty much are standard as before. But what is the biggest change you would say has happened in the past weeks that you're surprised about or has made I would say just what's the biggest change that has changed the market from today to 3 weeks ago?
Well, in reference to rates, the biggest change is how drastically they're changing. Typically, if we see like a 25 basis points. So in the mortgage industry, we call 1% 100 basis points. Okay, so we go by basis points. 25 basis points is 1/4 of 1%. So when we say that rates change by 1/4%, we're not talking about the rate itself. We're talking about the cost to get that rate. So if the rates change by 100 basis points, that means it costs you 1% more or less to get that same rate. Now, typically, Brendan, we see 20, 40 basis points changes, and those are big changes, right? As of lately, we've seen swings of 400 basis points from a lender in a single day for a specific product. So it's crazy,
Jesus.
right? So that's the biggest change, is the dramatic swings. You know, one lender will send us something saying rates have gone up. At the very same time, another lender will send us something saying that their pricing has improved, and that'll happen multiple times a day. And Joey, you know, I'll let you elaborate as far as, besides rates, what are some of the changes that are happening?
Well, I'd like to comment real quick on what you just said, just to add a little bit more, because it is a great point that you made. And that is why right now it is so much more important to have that relationship with not only your real estate agent, but also with your loan officer as well, because the market is changing multiple times a day. There's big swings. And so we're constantly monitoring the market to make sure that we lock those loans at the proper time. The other changes that we've seen are really just obvious changes. The closing process, you know, how are title companies handling in-person signings? We've opened the door for virtual escrow signings, and that really just depends on which title company you're closing with. But
that's nice to see, because we've been pushing for that for a while, especially the virtual ones. And I think the silver lining of all this is the possibility that this could start to get pushed through quicker than we thought it would.
Absolutely. I mean, they've made changes overnight, and that again is another reason to have a really good relationship with your loan broker, because they're seeing these changes on the front lines, and it's happening quick. And you need to make sure that we're communicating to our clients to keep them in the loop the whole time, because one thing that may have happened yesterday might not be available tomorrow. And so we need to stay ahead of the curve. But appraisals is another big change. You know, a lot of people, they don't want somebody coming in their home right now due to the situation. So our investors are adapting to these changes, and they're allowing for things like drive-by appraisals, where they don't actually have to go in the house to do these inspections. So there's been some drastic changes as far as those go, but I think they're all good, and they're designed for two reasons. Number one, to keep people safe, which is the most important thing right now. But number two, to keep the process moving forward as quickly as possible.
Absolutely. And I also think that, as you mentioned, Brendan, some of these changes are going to be temporary, but we also see that because of the innovation, a lot of these changes, like the virtual signings, are probably going to stay around and become a permanent thing.
Yeah, even these Zoom meetings. At one point in my house, I think my wife was on a Zoom meeting, my kid was on a Zoom meeting downstairs, my other kid was upstairs, and I was trying to get on one, and I was like, I don't know where to go. So it's funny to see everybody on Zoom, my parents, everybody. So I know a lot of people are unemployed from the Strip, and obviously, a lot of people had different processes. They were either starting a refi or trying to buy a home. Where are you seeing, I've had a few clients that were in the process. What's happening with the people who are currently furloughed or unemployed on the Strip? Are they still able to get a loan, or is that verification of employment? Does that need to be, do they need to still be employed?
Yes, they do still have to be employed. Now, a lot of the casinos are closed, but they're still paying their employees, right? And if they're still on payroll, they can still qualify for a loan. If they're not receiving payroll and they're unemployment, unfortunately, for the time being, they can't. That doesn't mean they can't talk to us, and we can put them in a position to qualify once they actually do start receiving income again. But if they are still receiving, I know, for example, the Wynn properties, Sands properties, Cosmopolitan, MGM, they were still paying a lot of their employees. So as long as they're still receiving employment, a paycheck, we can still qualify them for the loan. Now, there are more verifications of employment being done than normal, and that process has changed because a lot of those departments are closed. So the way we get the verifications of employment has changed, but we've adapted quickly. The industry's adapted quickly, so we can still get them qualified. There are some new guidelines that, depending on the investor, right? So some investors will say, if your place of business is closed, even if you're still getting the paycheck, we're going to limit debt to income ratios, or we're going to require X amount of reserves, or whatever it may be. The good news is that here at Streamline, we deal with over a dozen of the nation's top lenders, as we call them, investors. So we're not limited to one's guidelines. We can, if one, let's say, Loan Depot or Quicken or Caliber have a specific guideline that says they can't qualify here, we might be able to send them to somebody else and say, can you guys do this? And, you know, as Joey mentioned, it's very important that we get the application in place, not only to be able to lock the rate when it's needed, but if we get the application and we get the loan submitted, then it doesn't matter if the guidelines change because they're grandfathered into the previous guidelines.
Gotcha. Yeah, and that's I know that's been a definite question. I have a lot of clients that are from Cirque or from different hotels or casinos, and some are being paid and some aren't. So good to know that if they are, they still can get a loan. But unfortunately, the others, you know, will have to wait until we're back up and running again.
Hey, Brendan, one thing I wanted to add to that, and I think it's important just from personal experience about loans that are currently either in the pipeline or just closed. Just had one close from MGM, had no issues. Like Jonathan said, if they're on payroll and they're still, the verification of employment says they're still employed, it's not an issue. Had one close last week from Wynn, not an issue. This shows what's going to be really interesting to see happen is as these SBA loans that are part of the government bailouts start to happen and people start to get them, I'm sure we're going to have new overlays for investors to change the guidelines again to adapt to those. And I think it's going to be all positive.
That's a good point. Yeah, especially with the PPP program, if people can start paying their employees again, then some of them may actually start qualifying that currently aren't working, but they are receiving a paycheck. That's a good point. Another question I had was jumbo loans. I've heard rumors some people have completely stopped doing jumbo loans. Are jumbo loans still closing, and do they still exist? So there's been rumors that the whole system just shut down.
Well, unfortunately, those rumors are mainly true, right?
Yeah.
So most non-QM products like bank statement loans and asset depletion loans, those are basically non-existent at this point. And most jumbo loan products are also suspended for the time being, right? And the reason is they're not backed up by Fannie or Freddie or by the government, right? So when lenders lend on those products, they sell them as securitizations on the secondary market to, let's say, Goldman Sachs, right? But nobody's buying that product right now, so lenders are wary of lending on it. That said, there still are a few limited options, of which we have some available. But you know, if you're looking to get a jumbo loan, I suggest either you're going to have to wait or you're going to have to make a quick move because they're going away by the minute.
And I will tell you that I submitted a loan today, jumbo. It's a VA jumbo, and the loan amount's $707,000 at 3.99%. So they're still out there, but that's on the VA side.
And just for anybody who doesn't know what a jumbo loan is, what is the current threshold for a jumbo loan?
Well, here in Clark County, it's for a conventional, it's 510,000 or above. 510,400 is the loan limit for conventional and for VA. 345,000 is for FHA. So anything above those limits is either going to have to be cash. If you're getting a higher loan amount than the 510,400, then it's considered a jumbo loan.
Gotcha. Thanks. Yeah, just in case somebody didn't know what they were.
Mm-hmm.
So what should people have prepared in order to get approved? What are the things that they need in order to get approved for a loan?
So none of that information has changed. It's still going to be the same that we would do for loans pre-COVID-19. If you're W-2 employee, we need 2 years of W-2 forms. Right now, that would be 2018, 2019. We need current pay stubs to cover 1 month of earnings. If you get paid every 2 weeks, it's 2. If you're paid weekly, it's 4 pay stubs. 2 months bank statements on any asset accounts so we can verify where the down payment money is coming from. 2 forms of government issued ID. If it's a refinance loan, we ask for a copy of the current mortgage coupon. If there's any HOA payments, we ask for a copy of the current HOA bill, property tax bill, and homeowner's insurance bill. Still the same thing. That's not going to change. If you can put together a package with that information, I'd say 9 times out of 10, when we're getting the approvals back, we're getting approvals with 1, maybe 2 conditions. And a lot of that is title conditions, not lender conditions.
That's great. Yeah. And that's no different really than pre-COVID at all.
Yep.
So we've heard a lot about forbearance lately. Can you elaborate on what is happening with the forbearance? And explain
So,
actually what it is too, in case somebody doesn't know what forbearance is.
I can share my conversations that I've had with not only mortgage lenders, but also FDIC insured lenders. So a forbearance is basically a forgiveness for a short period of time on your mortgage payment, but it's not forgiven. It still has to be paid. And my understanding in talking directly with the lenders is, if you take an example right now of April, May, and June, so they will allow you to forego those 3 payments with your next payment due July 1st. The caveat is, not only do you have to make July 1st payment, but you've got to pick up the slack on the 3 payments that you missed. They want their money in full. However, when they send out these forbearance agreements, the terminology they're using is, we understand that most people are not going to be able to do that. They're not going to be able to write a check for $10,000 in July to bring their loan current. So if you qualify, that's the kicker. If you qualify, they will make a separate agreement on the 3 payments that you skipped. And so when you're making your payments moving forward, you still have to make some payment towards the 3 that you missed. If you can't, I think that's going to be a whole nother set of issues.
This is where it gets a little confusing, I think, for a lot of people, is the fact that they're like, I don't have to pay for 3 months, but then they're going to have to come up with 4 months. But then if they're behind on other things and they no longer have good credit, that means possibly they don't qualify for a payment plan to pay back the 4 months, correct?
Right. And the question I had for the servicing side of the business was, why don't you just take the payments and add it to the principal balance of the loan? And the answer is, because then it becomes a loan modification and not a forbearance. And if it's a loan modification, then you're going to run into stipulations with credit. It's a whole different set of rules. My recommendation is, unless you absolutely need to take advantage of that forbearance, then take advantage of it. But if you can avoid it, I think you avoid it at all costs right now.
Yeah, and I agree. I think, to elaborate a little more on that, HUD also passed recent guidelines saying that if you have an FHA loan, you can forbear up to 6 months. And after 6 months, you still need to ask for more forbearance. You can ask for 12 months. That said, we don't know exactly how the banks are going to treat it afterwards. If they're going to see you as a credit risk, for example, kind of like they did with short sales in the past, if you do a forbearance. So as Joey said, we recommend that if you absolutely need it, obviously take advantage of it, contact your servicer and try to work something out, but proceed with caution.
Yeah. It sounds like there's a lot of, red tape to go along with the additional choices. So can you tell us how the Fed lowering interest rates to 0 impacts mortgage rates? That was another question we had.
So the answer is, it doesn't impact them directly, right? So when people hear about the Fed's lowered interest rates to 0, and Joey can tell you, our phone was blowing up.
Oh, right away, yeah.
Yeah,
can I get a mortgage loan at 0?
Even me, they're like, at 0, it's 0,
yeah,
it's 0.
Yeah,
I'm like, no.
But those are for short-term rates. So it's what they call the Fed fund rate. So banks need to maintain 10% of all deposits taken in as reserves at all times. Okay, that they passed that after the Great Depression, when everybody pulled their money out of at all the banks, right? Everybody was freaking out, thinking the banks were going to run out of money. So back
then they took all their money, and now they take all the toilet paper.
Right, exactly. So in order for that not to happen, in 1930 they passed a law saying that banks need to keep a certain reserve, and that reserve is 10%. So, but banks, obviously, that limits their liquidity, so they like to borrow money from each other, and this happens every day. Now they can also borrow money from the Federal Reserve. That money obviously comes with interest. So when you hear that interest rate that is at 0, that's what they're talking about. But those are short-term rates. I mean, loans that banks are getting from the Federal Reserve in order to have more liquidity. The idea is that if they have more liquidity, then they will lend more to the consumers, and therefore get the economy going. That doesn't always happen, but that's the idea behind it, right? So indirectly, it can affect interest rates, because even though the Feds don't control mortgage rates. It's an indication of where Feds think that the market's headed, right? So it can either lower or increase rates. In this instance, for example, them lowering the rates actually caused a lot of lenders to have to increase their rates because it increased the risk.
Because of volume, right?
Well, because not only just because of volume. So there was already a huge influx of refis. We were doing, we had about an 80% jump in refis last month, okay, and in refi applications. So banks were already having a hard time keeping up. But the banks, when you lock your rate, right, the bank will tell you, okay, you can lock your rate for 30 days, 15 days, 45 days, whatever the lock is, but you haven't closed on the loan yet, and they have to sell that rate once it closes. So they promise you that rate, they have to keep that rate. But so what they do is they do what's called hedging. They hedge their bets against the market either going up or down, right? So they short the market and they bet in favor of the market at the same time. When there's huge swings, hedging costs go through the roof, right? Because you got to pay margins because you're going to lose big time on one of those. And that's what happened when rates really dropped big time. They lost on all those shorts and they got their butt kicked. I mean, there was actually a couple of the big lenders in the country that weren't prepared for it, and therefore they went out of business because they have to now pay their margin calls. Most of the larger lenders and the better lenders weren't affected by it. They just adjusted their ways of doing business. But indirectly, the Fed trying to help actually kind of hurt some of the mortgage companies in the industry.
And that's funny because that's the day we got all the calls from all our clients, and the next day it went up 1%. So like 0, 0, 0. The next day it was a full 1% higher. So it was like they were confused as anything. So obviously, I know the whole process has changed as far as, I guess you could say, as far as the actual in-person side of meeting the lenders, meeting the title reps, signings, all that kind of stuff. How are you guys speaking to your clients right now? How can someone get a hold of you? And if they do want to set up a meeting, what's the best way to talk to you?
Well, it's business as usual, right? We're just working from a different atmosphere. Our office, we have the ability to go in there. Obviously, we're working from home at the moment, but everything's digital now. So disclosures are sent digitally. Loans are submitted to underwriting digitally. Loans are submitted to processing digitally. Everything that we do is digital. It's a different day and age. Technology drives the business. Some of the bigger lenders that have these great technology platforms are extremely efficient right now. I could give you an example. Quicken Loans, they moved 18,000 employees to their home office literally overnight. Can you imagine moving that operation? But it's been an incredible experience for us because we're so efficient right now. I'll throw a disclaimer out there, but I mean, I've got refi loans that are closing in 14 days because of the efficiency of everybody moving to their home office. They don't have anything else to do but work.
There's no water cooler. Yeah.
Yeah.
If you don't have a water cooler,
people aren't ordering pizza at the office and hanging out in the break room for an hour. They're literally sitting in front of their computers and they're doing work. So the industry it's really changed in the sense that we've taken a business that is driven in the office and moved everything home, but the efficiency has really gone through the roof. It's been pretty cool to watch, actually.
That's pretty great. So if I'm going to buy a house, I contact you. Could I set up a meeting? If I get qualified and I find the house that I want, I can sign all the disclosures online. Obviously, you're available for phone calls, email. So from the day they go under contract to the day they close, you can do all of it hands off, correct?
Absolutely. And, we could do that before. As a matter of fact, I'd say that maybe 25% of our clients came in the office before. The other 75% did it all online or over the phone.
It's funny, and some people who haven't processed a loan in a while, or they've been in the same house for 10 years, aren't aware of that the market has changed that much, that so much is online. And especially for lenders, you guys, most of the time, like you said, you never even meet the client in person.
Yeah, absolutely. So that was already set up. And, so we have the ability to do that. Obviously now this type of Zoom calls or GoToMeeting or any kind of virtual meeting we can set up. We can still do it over the phone. But as we were talking about earlier as well, with the virtual closings, the drive-by appraisals, not just drive-by appraisals, a lot of, about even before this, about 1/3 of our conventional loans were getting appraisal waivers, which is nice, especially now that a lot of the appraisals don't want to go to houses, right? So
and
it saves you money.
And that's thanks to AI, right? Thanks to AI and things like that. Like the past year, we've had so many appraisal waivers because finally technology is able to narrow down the value of a property enough that a lender feels confident that, okay, yeah, we're good. We can do this without doing an appraisal, saving clients money as well, which is
we got an appraisal waiver on Ryan's deal today. So they're, like Jonathan said, I mean, it's probably 1/3 of them. And, I wanted to touch on one other thing that I think is important. The constant conversation all day, it happened today, is consumers they get lured in by the big banks, Chase, Bank of America, Wells Fargo, US Bank. All of these banks do mortgages, right? And I think that the typical consumer feels more comfortable going to a bank if they have their funds. You've got to understand that the banks want the cherry deals. They're not willing to think outside the box. They're not willing to bend on anything. And if you don't fit in that box, you're going to have a really difficult time closing. And I can't stress this enough. The realtor, lender, client relationship, that triangle is so important for having efficiency and also communication throughout the loan process. And if you go to Bank of America to get a loan, guess what? If you have a question at 7:00 at night, you're not getting an answer. If you deal with a mortgage broker, somebody like myself or Jonathan, we're going to answer our phone at night. If you call me on Saturday afternoon, I'm going to answer my phone. You're not going to get that service from the big banks. And guess what? Our programs are exactly the same. I just matched a deal today with US Bank, 30-year fixed, 5% down. And that was part of the decision for the client is this guy answers his phone every single time. Do I really want to go with the big bank who, once that loan goes into processing, the loan officers at big banks have very limited communication with their underwriters, very limited communication with processing. Whereas
usually it's remote too, right? Usually it's
remote
state and
and we're one phone call away.
That's a good point. That's a good point, and thanks for saying that, because there's many times with the listing when I get the lender approval, and when it's one of the big banks, there's always a little bit of a hesitation, and that's a very good point.
And they have multiple different departments, and you have to talk to somebody in this department now, and well, no, that part of the deal gets handled by this department. So it's a lot more frustrating dealing with them. And as Joey said, we have the exact same products, but we also have more products, right? Because if Chase on the retail side is only going to have whatever Chase products, whatever Chase offers, and Wells Fargo is going to have whatever Wells Fargo offers, and Bank of America and so forth. But we can go to all these different banks and deal with them. And guess what? We don't have any fees. We don't charge any fees to brokers. So it's going to be as if you went to all of them, saw who can give you the best deal and who can fit you, especially now that all these guidelines are changing, right? It's extremely important to have flexibility. As a matter of fact, we're seeing, just as a side note, we're seeing in our industry right now, the biggest gain on the brokering side of loan officers or loan originators than we've seen in the last 10 years, because a lot of the people, loan officers that are working for a big bank or a retail bank that only does their own products are limited right now, and they're losing a ton of clients. So they're looking for more flexibility. So they're moving to broker shops because they know that they can get the loans done there.
Yeah, that's a good point. And what's another thing that separates you guys from other lenders? I know there's some things that you do that separate you from other lenders. As far as fees, I know you hit on it a little bit as far as fees and things like that.
So I'll talk about a couple of things, and maybe Joe wants to elaborate. So we don't charge any processing fees, any underwriting fees, any origination fees. So we don't, as far as fees go, we don't have any fees. So it's your closing costs cannot be less with any other lender that will be with us, because we don't have any fees, right? So all the other fees that you are going to pay for closing costs, whether it's on a refi or on a purchase, are going to be third-party fees like title fees, escrow fees, taxes, things like that. But we don't have any fees, so you're going to save money there. Obviously, another thing we've touched on is the service. We pride ourselves in service, our experience. We have a great group. We think we're, obviously, and it's a little biased, but we feel we have the best team in town, and we have a lot of experience. And when we put this team together, the biggest thing we want to do is, hire people that were great at communication and that knew what they were doing, right? So our communication is on top of any other lender I've ever worked with. So I don't know if you want to say anything else, Joey, about that.
Yeah, I think you covered it. The experience is really important. We've got some really experienced loan officers at our company, and Jonathan and I talk about this all the time. But our back of the house is really where it's at. We're nothing without good processing and good closers. And we have I've been in the business 20 years, and we've got some of the best processing team that I've ever seen in taking care of these loans. And the best part is they care. They really care about our clients. And that goes back to the big banks. If you're buying a house or you're doing a refi, do you really want to be in a pool with 25,000 other loans that are trying to get closed? Or would you rather be one in a pipeline that is getting touched every single day and is moving through the process? So hands down, service, experience, pricing, and fees. Those are the four things that easily separate us from the rest. And, Brendan, you and I have been working together for probably about the last 6 months.
Yeah, exactly.
Yeah, working with your team. And, I think we have a great relationship going. Your agents have been awesome. I do my best. I try to always answer the phone when one of them's calling, because I know that they're either with a client or
I've been on the phone with you at your daughter's birthday party, at a restaurant. And
I was making cocktails
you can go.
on the earpiece. Yeah. I mean, that's the business though. If you don't answer the phone, you shouldn't be in this business.
Yeah, it's true. It's true. And it's hard to find, but honestly, yeah, you're 100% right. If you don't answer the phone, you absolutely shouldn't be. So what's the best way to get a hold of you guys? What's the website? If you don't mind, just run me down your email, your website, and your direct phone number, if you don't mind.
So I'll start. Our website is Streamline HL. So for home loans, streamlinehl.com. You can apply on there. If you can find all my information, all of Joey's information, just click on, you want to apply with Joey, for example, you just click on his icon and it'll send directly to his application, and he'll get your information. My cell phone is 702-515-9946. That's been my phone for the last 20 years, and you can contact me directly. Our office number is 702-213-4000. And mine and Joey's email is our first name. So mine, jonathan.jacobs at streamlinehl.com. His is joey.ciaglia at streamlinehl.com.
Excellent.
I have to correct you. It's actually Joseph.ciaglia. My last name is spelled CIAGLIA at streamlinehl.com. My phone number is 702-810-2552. It's always on. So unless I'm in the shower, then I don't answer. But I'm always
in the shower.
Sometimes. I think I've actually talked to you when I was in the shower. It was awkward, but.
So we'll drop all of that in the notes as well and in the comments below. But either, thank you guys, appreciate it. I know a lot of people have questions, so I think you got most of them pretty much. And if there's any other questions, everybody feel free to drop more comments down below. Both Joey and John will get them answered right away. But either way, I appreciate it, guys. Thanks for coming.
Absolutely.
Actually,
thanks for everything,
coming.
Brendan.
It's not like you came by. We got to do this digitally. So thanks for hanging.
Another reason. Awesome. Well, thanks a lot, you guys. I appreciate it. Stay safe. All right.
You too. Stay safe.
We'll
Have a good one.
Okay. Bye-bye.
Thanks, guys.